Welcome to our channel on accounting lessons with worked out problems. Brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Each topic also reviews concepts at the end if you need to brush up. Please do not forget to subscribe. This video is on accounting cycle. It will illustrate the steps in the accounting cycle: preparation of income statement, closing entries, and preparation of the statement of retained earnings and balance sheet. Before we begin the illustration of steps in the accounting cycle, let us review the steps. The first 4 steps involve entering all the transactions for the period in the journal, posting these in ledger accounts, calculating the balances in each account at the end of the period, and preparing the trial balance. The above 4 steps are covered in the video on journal entries and ledger accounts. The next 2 steps involve preparing the adjusting entries and preparing the adjusted trial balance. These 2 steps are covered in the video on adjusting entries. The final steps involve preparing the income statement, closing the accounts, preparing a statement of retained earnings, and preparing the balance sheet. All these final steps are covered in this video. Another step that involves the preparation of statement of cash flows will be covered in a later video. Let us begin the video with a description of the problem we are going to illustrate.
And here, this is an adjusted trial balance for BBB company for the year ending December 31st of 2024. So based on these adjusted trial balance, we will do the income statement, closing entries, statement of retained earnings, and the balance sheet. First, we are going to prepare the income statement. So income statement, you report all the revenues, all the expenses, and you calculate the income or the profit, and you show it. So first, you are going to prepare the income statement. First, you list the revenue. First, service revenue, $300,000. And then you show all your expenses. First, you have salary expense, $98,000. Rent expense, $12,000. Utility expense, $6,000. Insurance expense, $4,000. Supplies expense, $7,000. And finally, the depreciation expense, $10,000. We add up all the expenses. You show your total expenses, add up everything. That comes up to $145,000. You subtract the total expenses from the revenue. That gives you your income. 300,000 minus 145,000 gives you 155,000. Once you have done the income statement, you prepare your closing entries. Now, to prepare the closing entries, we are going to close the revenue account, all the expenses account, and finally we are going to close the income to the retained earnings account. So first, you have to open up the revenue account, and that was showing a balance of $300,000. And then your salary expense, ledger account will show a balance of $98,000. Your rent expense will show a balance of 12,000. Your utility expense will show a balance of 6,000, and your supplies expense will show a balance of 7,000. Your insurance expense will show a balance of 4,000. And finally, your depreciation expense will show a balance of 10,000. And then your retained earnings will be showing a balance of 60,000. And now we are going to do the closing entries. So when we do the closing entries, we open up another account called an income summary account. And this income summary account is alive only during the closing. It's opened up and finally it is closed down to zero at the end of the closing. So first we are going to close the revenue account. So for that we are going to debit service revenue 300,000. Now the balance is zero, and this $0 balance will be carried over to the next period. So first we debited service revenue, you will credit the income summary 300,000, and then you close all your expenses. So all expenses have debit side balance, so in order to close them you will credit. So first close 98,000, take it to income summary debit 98,000. Credit rent expense 12,000. Now the balance is zero. Debit income summary 12,000. Now credit utility expense 6,000. Balance is zero. Debit income summary 6,000. Supplies expense, credit 7,000. Debit income summary 7,000. Insurance expense, credit 4,000. Debit income summary 4,000. Finally, depreciation expense, credit 10,000, balance is zero. Debit income summary 10,000. So we have closed the revenues and we have closed all the expenses. Those account balances are zero now. Now you go to the income summary. You have the credit side 300,000, debit side all this account. When you balance it, you have 155,000 on the credit side. This would be equal to your income here. So now you have to close the income summary. The final closing will be to debit income summary for 155,000. Now you are bringing it to zero. Debit income summary for the profit or income 155,000. Credit retained earnings 155,000. Now the only account now that has a positive balance is the retained earnings. So now after closing, the balance in the retained earnings is 215,000. So the retained earnings should be adjusted for the income amount. So when there is an income or a profit, you will add it to the retained earnings by crediting. If the company has a loss, you will subtract the loss from the retained earnings by debiting. Okay, folks? Okay, next one we are going to prepare the statement of retained earnings. So I'm going to erase this part of the board The statement of retained earnings tells you the changes happening to the retained earnings account. So here, statement of retained earnings. So retained earnings, before it was on $60,000. To this you add your income, 155,000. Now there is no dividends here, okay folks? So the dividends will be 0. Therefore, you can just stop here and calculate the balance, or you can also say dividends 0. If the company has paid any dividends, then that dividend amount will be subtracted. Now the balance will be 215,000. This is the balance of your retained earnings as of December 31st, 2024. So this is how you prepare the retained earnings. Next, we are going to do the balance sheet. And again, I'm going to erase the board because we need some space to do the balance sheet. Now you know the retained earning balance is 215,000. This balance will be reported in the balance sheet. And in the balance sheet, we report all assets, liabilities, and owner's equity. Now we go to the balance sheet. So here, balance sheet, first you list all your assets. First you list your current assets or short-term assets, and then you will list your non-current assets or otherwise called long-term assets. So first comes your current assets. Again, these accounts are coming from your adjusted trial balance. So have you cash 80,000, accounts receivable 40,000, office supplies 5,000. So total current assets, if you add them up, you have 125,000. And then you go to your non-current assets. So here you have land 200,000. Then you have the building 120,000, and the building has accumulated depreciation. So you subtract your accumulated depreciation of 20,000. So your building's net value is 120 minus this 20 gives you 100,000. So total non-current assets equals 200,000 plus 100,000, $300,000. Now total assets is the sum of your current asset total and non-current asset total. That equals 125,000 plus 300,000, 425,000. Now you go to the liability section. Again, for liabilities, you first list your current liabilities. So here you have account payable, 12,000, salary payable, 18,000. So total current liabilities equals 12,000 plus 18,000, 30,000. Then you go to your non-current liability. Under this you have note payable, $100,000. Now total liabilities now equal $130,000. Now you go to your shareholders' equity or owners' equity. So first you have your common stock, 80,000. And then you have your retained earnings, that was 215,000. So total equity is this plus this, that gives you 295,000. Finally, if you remember your accounting equation, total assets must equal total liability and equity. So now liabilities plus owner's equity, this plus this gives you 425,000. So using this adjusted trial balance, we finished the last steps of the accounting cycle, preparing the financial reports and closing the entries.
In the previous part of the video, we worked out a problem on the accounting cycle. We prepared the income statement, closed the accounts, prepared the statement of retained earnings, and prepared the balance sheet. The remaining part of the video will review the concepts in the accounting cycle.
Accounting cycle is the process by which the companies record all the financial transactions, including the adjusting entries, measure the effects of these transactions, that is, they evaluate the effect of these transactions on the company's financial condition, and report them in the financial statements. Now, what are those financial statements? First, income statement. Income statement reports revenues and expenses, and it also reports all other gains and losses. And finally, the bottom line is the profit or the net income earned by the company for a specific period. Statement of retained earnings. This statement reports the increases and decreases to the retained earnings account. Now, the retained earnings can increase when the company earns a profit, or decrease when the company incurs a loss, and also it decreases when dividends are paid during the period. Number 3, the balance sheet. The balance sheet reports the financial position of the company as of a specific date. So it is a snapshot of the company's financial position on one particular day. Usually this day is the end of the accounting period. Now here in presenting the balance sheet, assets and liabilities are classified as current and non-current. Now, what do we mean by current? Current means it has a life less than a year. Therefore, all current assets have a life of less than a year. That means the company will use up those assets within 1 year. And current liabilities, and these are the liabilities that have to be paid off within 1 year. Now, non-current. These are the assets and liabilities that have a life of 1 year or more. So, non-current assets such as land, building, machinery will stay with the company for a period more than 1 year, and the company will benefit from these assets for a period more than a year. Non-current liabilities, they have more than 1 year to be repaid. Now, owner's equity. Owner's equity is always a long term. Finally, the statement of cash flows. This statement reports the inflow and outflow of the cash over the period, and finally, the cash position at the end of the period. Now let us look into the steps in the accounting cycle. The first step is to enter all the transactions for the period in the journal. The next step is to post these transactions in the ledger accounts, otherwise called the T accounts. Now, we go to calculating the balances in each account at the end of the period. Now, the company is ready to prepare the trial balance. Now, steps 1 to 4 are covered in the video on journal entries and ledger accounts. That is lesson number 2. The next step is to prepare the adjusting entries. After all the accounts that needed to be adjusted are adjusted, now the company prepares an adjusted trial balance. Step 5 and 6 are covered in the video on adjusting entries. Now, once the adjusted trial balance is prepared, now the company is ready to prepare its financial reports. From the account balances listed in the adjusted trial balance, first the company prepares the income statement, and then it closes the temporary accounts, which are revenues, expenses, and dividends. And then, after closing those temporary accounts, it prepares the statement of retained earnings. At last, the company prepares the balance sheet and statement of cash flows. Now, steps 7 to 9 are covered in this video, and statement of cash flows will be covered in detail in a later video. Now, closing the accounts. This is the end of the period process that prepares the temporary accounts, that is the revenue, expenses, and withdrawals for the next period. Balances in the revenue and expense accounts are closed to 0 so that they can measure the revenues and expenses and the income separately from the previous periods. During the closing process, an account called income summary is opened. Revenues and expenses are closed to this account. To close the revenues, we will debit all the revenue account and we will credit the income summary. To close the expenses, we will credit all expenses and we will debit the income summary. And then finally, we close the income summary balance to the retained earnings. Now, if the income summary balance is on the credit side, that means the company has earned an income or a profit. So to close the income summary that has a credit side balance, we will debit the income summary and credit the retained earnings. Suppose the income summary balance is on the debit side. That means the company has incurred a loss. In that case, we will credit the income summary and debit the retained earnings. And finally, in order to close the dividends or the withdrawals, we will credit the dividends and we will debit the retained earnings. Now the retained earnings account balance is updated for the income earned and for the dividends paid.
Thank you for watching the video. We hope we were able to help you understand the accounting cycle. We have video lessons with worked out problems on all topics of financial accounting. Please do not forget to subscribe. We hope to see you in another video lesson.